Hello everyone, it's Michael Pollitt from the Judge Business School here, and welcome to my alumni talk on promoting green growth. So of course a lot of people have been talking about promoting green growth, and I'm going to sort of talk about whether that's a good idea or not, or what we might mean by that. First of all, let me just acknowledge that I'm going to be talking about some work that I've been doing with some of my colleagues at the Energy Policy Research Group. Victor, Kareem and Geoffroy share in the glory and the shame of this working paper that I'm going to draw on, which is available on our website. I want to thank Ofgem, the Great Britain electricity and gas regulator, for prompting this initial work on productivity in electricity and gas sectors since privatization, and that sort of is some of the inspiration behind the work that I'm going to talk about. And I should also mention Professor Diane Coyle at Pollitt in Cambridge, who, much to her credit, has just been part of a large consortium bid to the ESRC, which has successfully won £37 million to look at the productivity question in the UK, why productivity growth appears to be so slow and what we can do about it in the UK. And we're part of this Productivity Institute. So what I'm going to do is I'll talk a bit about how you measure growth and the sort of growth that I'm talking about when we talk about productivity growth. I'll talk about expectations of why green growth, by which we might mean, you know, a growth which decarbonizes the whole economy, gets us towards net zero greenhouse gas emissions. You know, how's that sort of policy set impact on growth? Then I'll move into a wider question, which I think this raises, which is the move away from what we might call the growth economy, which we've seen over the last 200 years since the Industrial Revolution, towards a sort of post-growth economy. Then the related question, which many of you who might be in the financial services industry could be interested in, which is, well, what does this mean for the value of companies in our economy? Is this going to increase stock market values, for instance? Total profits in the economy, will those go up as a result of the green growth policies that we might follow? And then I'll sort of draw some conclusions. So I do need a bit of maths, so don't get too scared, because I'm going to just use this to give some background about what we're actually talking about. So when we talk about growth, we have to start by talking about the economy, talking about GDP, and GDP is just the sum total of value added in the economy, what people add to the underlying materials that you use to create goods in the economy. So GDP itself is going to be driven by the amount of labor you put into production, the amount of capital you have, and the amount of materials you might need. Of course, these materials are often energy related or raw materials related at their heart. And the economy can be thought of as something which transforms these underlying inputs into output, into total value added in the economy. Of course, the trick is to use as little input as possible to create as much value as possible. And the higher productivity is this A function in this equation, which inflates the value of the underlying inputs into valuable output. And you can think of productivity growth as being about increasing the effectiveness of this A function, this multiplier effect on inputs, and GDP growth itself being a joint function of increasing the inputs or increasing this productivity in the economy. And there's a famous economic analysis around growth accounting, where you try and account for GDP changes over time by trying to decompose it into growth of labor, growth of capital, growth of other materials, and this A factor, this productivity factor. And this residual that's not explained by underlying growth of inputs is what's called total factor productivity. So when we break down the growth of value added in that little equation at the bottom, what we're talking about is trying to break down the growth of value added into changes in the inputs and changes in productivity itself. One of the things that's true of the British economy, for instance, is actually population has been growing in the UK, number of people working has been growing, working hours have been growing, and actually that's been the major contributor to recent economic growth. So economic growth in the UK has been very much driven by inputs and not by the A factor and productivity itself. So aside on COVID-19 and the impact of COVID on growth, of course, all these things are badly affected by COVID. Your productivity function, this A factor, has been badly impacted by COVID because you've got the wrong technology, the wrong types of skills in the economy. Yes, if everybody was in IT, that'd be okay, but they're not. Many people are in services, services which have been badly disrupted by COVID. You could see just on the right there, I just picked out 6% of the economy which has sort of vaporized as a result of COVID. Sectors which rely on mass people involvement, people movement, and you know that bit of the economy is badly affected, and the labour and the capital involved in that is underemployed at the moment. And if you're going to adjust the economy post-COVID to a situation where there needs to be more physical distancing permanently, one can think of that as being a major exercise in redeploying inputs around the economy and trying to change the nature of the technology in your economy. Of course, these major redeployments of inputs in the economy have happened before. Looking for inspiration, where would a good Cambridge economist go but to look at some of the writings of the most famous Cambridge economist, Maynard Keynes. He wrote a lovely book, short book, about how to pay for the war in 1940, where he talks about, you know, how do you redeploy 25% of the economy away from private consumption and towards war production, and how do you do that in very quick time. And actually, as you can see, what actually happened in that figure at the bottom is a big increase in total output and a massive redeployment of output from private consumption towards war expenditure. So you know it can be done, and it's important to say that when we talk about green growth and this long-run transition to net zero, this is very different from the sort of fast COVID redeployment that we might want to see within, 18 months, for instance. Net zero by 2050 is clearly a very different time frame to redeploying, a significant share of the economy that's been affected by physical distancing to other uses. So just to reiterate what I said about UK productivity. So if you look at this graph from the ONS, so the headline is what's been, the curve in here is what's been happening to output since 2008, since the financial crisis. It has gone up, sort of the order of 13% up till end of 2019. But why has it gone up? If you look at the combinations of inputs, input growth, and what's been happening to this A factor, this underlying multi-factor productivity growth, as it's called here, actually it's all about increases in inputs. Big increase in total labor hours, some increase in capital, some improvement in labor composition. So, over time we are moving towards more people in the economy having better skills. Average levels of education are going up, and that of course moves people from less productive employment to more productive employment. So that factor is important. But this A factor is actually declining, or is actually lower in 2019 than it was in 2008. So, you know, if you like, the magic of how we turn inputs into output, that isn't improving. And of course, that is surprising given the huge amount of technological progress we see around us. So technological progress is obvious everywhere, apart from in the productivity statistics. And that's really important to sort of bear in mind. And of course, not just the UK, where this total factor productivity growth is A factor improvement has been slow. If you look at many economies, many OECD economies, you see a slowdown in productivity growth from before and after the financial crisis. And indeed, the slowdown is even bigger if you just pull out what's been happening in the electricity and gas sectors. So in the electricity and gas sectors, productivity growth has actually been largely negative across OECD countries. So, you know, there is this big productivity puzzle, which is to be explained, which is sort of not obvious. You know, we see technological advances all over the place. We see technological advances in the delivery of electricity and gas, but we don't see it in the productivity statistics. You know, if you decompose what's been happening, you see that you know, input growth has continued. So, you know, we should be getting some more output as a result of increased labour and capital being put into the economy, as we saw for just the UK. But what has been happening is this A factor has been declining, and in some countries has been negative from before and after the financial crisis. And that's true in energy sectors as well. It's true for the whole economy, and it's true for the energy sector. And we might want to think about why it is that productivity appears to be declining across the whole economy and across just electricity and gas. Now, in a way, it's not that surprising that there's a productivity puzzle in energy itself. One of the things that's been happening as a result of aggressive climate policy and aggressive energy efficiency policy is actually across Europe, as you can see, actual energy consumption has been declining. So what we've got is a situation in Europe where energy consumption is actually declining, but actually the amount of labor and capital we're putting into the energy sector is going up, you know, as we switch to renewables, as we reinforce our electricity networks to cope with variable intermittent renewable generation. You're putting more capital into the system and the output is declining. So the value of that output is going down. So that is maybe what's lying behind the fact that we see quite a big productivity reduction in the energy sector. And we've done some more work trying to look at this econometrically across the OECD. You know, is it true that low carbon energy policy is correlated with productivity reduction? And the answer is yes. If you have higher levels of renewable capacity, if you have more success in reducing energy demand, those things reduce productivity levels in your electricity and gas sectors, not surprisingly. And indeed, one can go further. And we find evidence that having climate policy is actually, you know, having tougher climate policy is actually correlated with reduced levels of productivity for the whole economy. So higher carbon prices, higher amounts of renewables roll out, that does seem to be correlated with lower levels of productivity across the whole economy. not just in the electricity and gas sectors. So, you know, so one of the things to keep in mind is when people advocate green growth, which is about putting more capital into low carbon technologies, promoting energy efficiency, those things are not necessarily correlated with higher rates of economy level growth, or even growth in the particular sector where you're putting these higher levels of capital input in. So, you know, first point, green growth is something of a mirage. I mean, why would we expect the economy to actually grow if we're decarbonizing it? So in spite of this, many people are advocating green growth. Nice report from the International Energy Agency, where they do all sorts of comparisons between things that are green and the amount of jobs that you would get from $1 million of extra investment in those things. So something like spending $1 million on pedestrian and bike lanes, actually that creates quite a lot of jobs. You know, it's quite cheap to create a pedestrian lane, though not in Cambridge, where we've had the magic Dutch roundabout, which went massively over budget. But that's better than something like, as you can see, battery manufacturing for cars, which actually creates a very small number of jobs per $1 million. So, you know, yes, spending money on green things does create jobs, may not raise productivity, but it does create jobs. But actually it creates very different numbers of jobs according to the different technologies that you're talking about. And I would be remiss as an economist not to point out that the major failing of this sort of analysis is you're not comparing it with all the jobs you could have got in other sectors. If you really want to get jobs in a post-COVID world, of course you invest in things like teaching assistants or hospital porters, because you get far more jobs per $1 million of investment than you do in any of these energy technologies. So, you know, creating jobs as a result of green growth, that's not a good way to create jobs quickly. Okay, now, if that's all a bit sort of depressing, I think we need to sort of go back to fundamentals around growth itself. You know, the real issue with decarbonisation is the proper valuation of environmental services. So one of the things that COVID has taught us is the value of the local environment, that people, you know, people are forced to live locally. They're very interested in local green space, the quality of the air locally. And all of these things are not part of conventional GDP. You know, you could have a very high quality environment that you live in, and that's not in GDP. And various people have written about this very instructively. This lovely book, The Economics of Good and Evil. Sadlerchek points out that, you know, we're obsessed with growth economics. We assume that growth is good, whereas actually he makes this lovely point that one of the things that is the least good for the economy is pure friendship. You know, if I spend time talking to my friends, that is time I'm not spending working. And this idea goes back to the earliest piece of writing in history, which he sort of starts with his book with. And it goes back to a nice paper by Dixit and Grossman, who make this rather nice point that if people were to spend their lives as monks or as nuns, and you know, spend their lives with very low environmental impact, manage their you know, own food supply in their own garden, that would be terrible for GDP. It might be wonderful for the quality of people's lives and for the impact of human activity on the environment, but it really would be bad for GDP. So, you know, the idea that GDP itself is a good thing is a somewhat odd idea. Kenneth Boulding wrote a very interesting and quite prophetic book, I think, quite prophetic article, where he distinguishes between the cowboy economy and the spaceman economy. And what we've been living in, he claims, is the cowboy economy. This idea that we can endlessly expand production and consumption. There's these high planes which we're just stretch on as far as the eye can see, and we can, consume more of the resources that these things support. But actually he says that economy must reach a limit at some point, and soon we'll be living in the spaceman economy, where we've got a closed system and we just have to make use of the resources that we have and improve our recycling. And actually we can't constantly be growing output. And that's related to an idea by Herman Daly, where he discusses the steady state economy, that increasing the throughput of the economic system, which is what GDP is a measure of, that is not really sustainable in the long run. Then actually what we need to do is realize we're operating under these steady state constraints, that we can increase services, but only if we can constrain the throughput at a sustainable level. We can't, if we have too much throughput, our assets begin to fall apart and we get too much pollution that we can't handle. So throughput is going to be constrained in this steady state spaceman economy. And the only way we're going to get sustainable economic growth is if we can keep expanding knowledge and avoid depleting the stock of capital and environmental services that we've got. So this all points to about the issue of how do we measure GDP properly, because GDP doesn't take sufficient account of quality of life issues, ecosystem services, air quality. And the whole idea of seeking after this total factor productivity growth, really problematic, given that we can only do it with destroying the environment at the moment. And indeed, the problem of improper measurement is not just about the energy sector or energy related issues. It's also to do with things like the internet. Halvarian has this famous calculation. He is the chief economist at Google. How valuable the free service of Google to users is. And that just doesn't appear anywhere in GDP. So improvements in internet technologies, often those go straight into consumer benefit. They don't pass through GDP. So one of the reasons why we don't see all these technological improvements all around us showing up in GDP is because we just get the benefit straight delivered to us. It doesn't ever have an economic financial value put on it. And indeed, some of these things are statistical quirks. It turns out that, of course, I brushed over this, but to measure real GDP adjusting for inflation, you need to get your measures of inflation right. And you can see there's been an adjustment recently in the price of telecom services in the UK, where it now appears that the price has gone down an order of magnitude more quickly than the ONS previously thought. And this means that the value of the output is much higher than previously thought. So there's maybe simple statistical reasons why we've mismeasured some of these new technological improvements and their impact on GDP. Now, of course, lower levels of GDP growth, measured GDP growth, have some really important implications. One of the reasons why GDP growth is such a good thing is because it offers the chance to deal with poverty and distributional fairness. If the economy is generally growing, it doesn't really matter that the rich might be getting richer faster than the average, because the poor, hopefully, are getting better off as well. And if at the very least, the government's able to transfer some of this growth down to help the poorest people in society or to provide better public services. If the economy stops growing, one of the implications of that is you need to address distributional fairness within the current income distribution. The other thing that happens if the economy stops growing in measured terms is you can't borrow against the future. So one of the reasons why people started measuring GDP was because they wanted to know what the borrowing capacity of the government was. You know, if you have bigger GDP, you can borrow more money as a government. If GDP stops growing, then of course your ability to borrow against the future is reduced, and you can't use intergenerational debt transfer to finance current expenditure. So both lower rates of GDP growth and total factor productivity growth, well, what do they imply for rates of return? So this is getting to the value question, you know, the value destruction question. Now, in theory, if GDP growth starts growing more slowly, then rates of return, measured aggregate rates of return on investment must fall in the economy. Now, how that translates into the stock market is not, it depends on how leveraged the economy is, and you know, the extent to which share values reflect underlying capital value in the economy. What is true is that if the economy starts growing more slowly and shareholders were initially pricing in rapid economic growth, once people realize the economy is not going to grow as rapidly, then share prices should fall. There'd be a correction to share prices. And indeed, some of the most interesting recent work on rates of return on assets shows that rates of return do follow big cycles. They can rise and fall cyclically over many decades, and that they appear to have been falling for 700 years. If you adjust for default rates on rates of return on debt, for instance, that, you know, it used to be really risky to lend people money, especially kings and queens, because they often didn't pay you back. Now it's got a lot less risky, got much deeper and bigger financial markets, and you know, actually returns are a lot lower than they were 700 years ago, and they've been falling more or less continually over that period, you know, apart from these sort of cyclical increases and decreases. So what might we expect the green economy to do to, say, stock market values? Well, the UK stock market is really dependent on natural resources, especially for dividend payments. You can see that for these 6 companies are responsible for more than 40% of all dividends paid in the UK. And, you know, the end of the carbon-based economy, where there are big resource rents built into anybody who's trading in oil and gas or producing oil and gas, that has got major implications for dividend returns in the UK stock market. And indeed, you know, people who've looked at this have thought, you know, if we have serious climate targets globally, this means many of the identified oil and gas reserves, which are priced into oil and gas companies who are big dividend payers globally, they will be stranded. They'll never be taken out of the ground, and hence the value of those companies must drop. And that's going to be, you know, serious for stock market valuations. So moving to a steady state economy implies, you know, less risk in terms of, you know, we're not going to have so much variation in throughput, because we're going to be trying to maintain throughput at sort of safe for the environment levels. Less risk means falls in rates of return and the cost of capital. You know, we're not going to be having this cowboy economy type never-ending growth. But at the same time, we might need to be putting in a lot of capital into the economy to decarbonize it. So you can imagine if the government is sanctioning a lot of this investment in low carbon technologies to meet government targets, government's going to pay a lot of attention to the rate of return that private investors are getting, and that's likely to be squeezed. You know, because the government's going to say this is not very risky overall, and it's costing us significant amount of money, and there'll be more attention paid to rates of return. So rising investment in green related assets combined with lower actual or desired rates of return is likely to increase pressure on private ownership. Calls for state ownership are likely to increase. It's already the case that the sectors that are primarily affected by decarbonisation, so electricity, gas, and transport networks, in the UK, they are significantly in private ownership, but in many other OECD countries and in many developed countries, these are largely state-owned or municipally owned enterprises, precisely because society is concerned about rates of return that private companies might be able to extract. And if you haven't seen a really interesting document from the UK's Labour Party, which is still Labour Party policy, to renationalise both electricity and gas networks in the UK, partly in response to these sorts of arguments that, governments put a lot of money into these sectors. We've set very ambitious targets for them. The amount of capital in them is going to be going up, and we don't want, high rates of return being seen by private companies there. So should the government promote green growth? I'm sort of cautious about the effectiveness of, a whole concept of green growth. That's what I've sort of tried to say. That I think green growth are two words that shouldn't be put together. That doesn't mean we shouldn't have green policies. That doesn't mean that a steady state economy isn't a good thing, or, can't be a good thing, because we'll be properly valuing all these environmental services that we might be getting. And it doesn't mean that sensible green policies are not important. We've had some really effective green policies in the UK recently. One of the most interesting has been pricing carbon properly in the electricity sector, which has been a combination of the European emissions trading system price plus our local carbon price support tax on carbon in the electricity sector. And that has massively reduced the amount of coal in the electricity sector. So basically we're burning almost no coal in the UK electricity system, having had a system in 1990 which was 70% coal fired generation of electricity. And that has been a policy which has had a big effect recently in reducing coal use. So that's a good environmental policy. Should the government promote green growth? Yeah, well, not if it's going to be bad industrial policy. The question for promoting investments and companies which are decarbonising the economy is, are we going back to the 1960s, 70s and 80s in the UK where we tried to promote and save companies that turned out to not be worth saving. And indeed, it was other policies which were more general, were not company specific, things like, pricing carbon properly might be a good example of one, which actually were responsible for the revival of the British economy in the late 1980s, promoting foreign investment, proper rationalization of industry and startups, some of whom eventually became very successful. We need to not go back to those bad industrial policies in the name of green growth. So can the economy still grow if we're heading towards net zero? Well, partly it's going to depend on, the ability to grow the non-resource dependent economy. You know, the economy which doesn't depend on stocks of environmental assets, you know, is the sort of knowledge economy, the gigabyte economy, you know, if we can measure it properly, and if it, you know, responds to growth metrics, you know, yeah, maybe we can grow. But I think we'd want to be pretty skeptical about the idea that every OECD country can grow if it converts to low carbon. That's not at all clear. You know, only some countries are going to benefit from the capital goods investment in low carbon, you know, maybe Germany, but the UK very unlikely, and many other OECD countries. You know, partly because this green capital investment is actually quite a small part of most economies. But you know, maybe the solar economy creates a new cowboy type frontier where, you know, there's endless amounts of solar energy. You know, maybe we can just get cheap solar energy and growth can continue as before. Yeah, but there are lots of other resource constraints in the economy which might be a problem. So just to conclude, the whole idea of green growth is theoretically pretty dubious, as I've tried to point out, both in theory and empirically. You know, it doesn't mean that clean growth isn't a good thing, but green growth is not the sort of recovery that we might need in COVID, because that we need a much more rapid recovery than some of these long-term investments might give us. And it does seem likely that if we're serious about net zero, that has major impacts on rates of return across the economy and on stock market valuations and dividends. And is it, you know, is that sort of transition a bad thing? Well, of course not. You know, it's not a bad thing, given that, you know, we've got, you know, the stock market is owned by a small number of people in the whole economy. You know, we've got serious distributional concerns in capitalist economies. What I didn't point out was, yes, the economy's been growing, but as we know, most of the growth in the economy has been focused, you know, most of the benefits of the growth of the economy have gone to the richest 10% in our economy. And actually the average and the median worker in the economy hasn't been benefiting from generalized economic growth. So I'll leave it there, and I'll look forward to looking at some of these questions that people have asked me. Thank you very much. Do use the Q&A function. Yeah, let me go to the end here. So do I think GDP is becoming an outmoded tool with which to measure productivity? Yeah, absolutely. I think one of the things to say is that, you know, it's interesting, some of those readings that I was quoting are from the 1970s. There was a lot of concern in the early 1970s about the slowdown of growth, you know, and the need for the economy to slow down. And you know, people talked about the measurement question then, but we still haven't addressed the measurement question and the need for us to have a much more rounded measure of economic welfare than we've currently got. I think the one thing I would say to temper that is this borrowing question. You know, the GDP measure that we do have is important for other things. And it, you know, yes, we could remeasure GDP in sort of notional values, but because they're non-financial, that would have implications. So, you know, I tell you that the value of clean air was worth £500 a year of income to you, but of course you can't spend that. So these actual GDP measures, of course, are important for determining people's real spending power and the government's real capacity to borrow. Yeah, does the maths help? Yeah, of course it does. Yeah. Yeah, why have we been pursuing growth? So why is perpetual growth sought after? It is a good question. Would it be a concern if I told you the economy was never going to grow again? It's grown for the last 200 years, with very short interruptions. Well, the answer would be, if I told you that, that would lead to an immediate correction in expectations. We've got all of the investments which have been made in our economy are premised on growth. They've already built in a growth expectation. If I told you that a growth expectation had changed from 2% a year in the UK to 0 permanently, stock market values would collapse. Government borrowing capacity would collapse. Individual investment plans might collapse. So, clearly would have major adjustment issues associated with it. Yeah, no, people, how is development being measured in a society as a result of humans increasing skills with using digital technology? So how you measure the impact of digital technology is a really interesting question. And again, this isn't a new thing. So people said at the end of the 1990s, the one place where you can see the internet and computer revolution, one place where you can't see the internet revolution or the computer revolution, personal computer revolution, is in the productivity statistics. Now, there might be two reasons for that. One is that all the benefits are in terms of consumer welfare and not financial. So, I save time, I get enjoyment and variety, none of which show up in measured GDP, none of which I pay for directly. Okay, that could be one reason. The other reason could be that, of course, it takes time for these effects to actually become positive. So one of the things people worried about with the computer, the rise of the personal computer or the internet, was that, well, of course, what people start doing is they start wasting time on their personal computer. So yeah, everybody at work gets a personal computer and they just all start browsing the internet to look up, the next pair of shoes they're going to buy. And they're not actually using it for work. And it might take time, or it could take 20 years before people fully realize the work benefits of some of these new technologies. And one could argue that what we've been discovering in COVID are some things like that. The technology to have an online meeting has existed for 20 years, but people have barely used it. Because they've wasted time in all these physical meetings, which they shouldn't have been having. And so maybe, it takes time for people to learn some of these things. Yeah, maybe. But it could be that, we never see an actual measured benefit from these things, even though we might be enjoying the increased welfare from some of these things. Yeah, so things that we measure badly in the economy are the value of variety. So one of the things that's most difficult to measure is, what is the value of more choice? So what's the value of being able to go on your computer and browse Google and get all these options, and that is something that's very difficult to put value on and measure. And it's one of the major benefits of a market economy, is you've got choice and you've got options. And if one option doesn't work out, you've got loads of other options. And, measuring the value of that is always going to be difficult. Of course, one of the implications of a net zero economy is, hang on, we might need to constrain people's choices. you know, sorry, you're not going to have the option to get the non-recyclable cup. You're going to have to bring your own recyclable cup along to get your coffee, and unless you do that, you're not going to get coffee. That's obviously reducing choice, yet it might be quite a sensible thing to do if you're serious about the net zero economy, to actually rule out choices and reduce variety, and in some sense reduce consumer welfare. What some economists have called, you know, one of the sort of tyranny of consumer preferences, you know, the idea that any consumer preference is valid, you know, and if people want it, they should be able to get it, you know, within the law. You know, one of the implications of a net zero economy is we need to begin to restrict some choices in the name of hitting net zero. And of course, that is at some level, that is a loss of value in the economy. Yeah, why is Google free? Of course not. Yeah. So one of the issues in GDP measurement is it doesn't capture these two-sided market questions. Something like Facebook or Google are an example of what's called a two-sided market, where there are two groups of users. You know, there's the advertisers who use the platform to reach customers, and then there's the people who are using the search engine or you know, meeting their friends on Facebook. And actually, the way to maximize profits in that sort of two-sided market is to charge one side of the market all of the costs and recover all the profit from them, and to give it free to the other side of the market, because having maximizing number of users is the way that you maximize the advertising revenue. And so that's why that is an optimal way of doing things. But what it tends to do is massively undervalue the benefit of the to the users of simply being able to have the platform. And this was sort of Arian's point about Google, but it's also true of Facebook and other platforms that operate like that, where you charge one side of the market you recover all your revenue from them, and essentially you're extracting some of the value from that side of the market, but you're not actually extracting any of the value from the other side of the market, which is sort of Arian's point. He also makes the point that, you know, just by increasing the efficiency of search, there's other value there which is also not being captured as in a conventional GDP measurement. Yeah, one could have somebody's asked me about many oil and gas companies are jumping into renewable energy. Yeah, they're wasting your money, basically. You know, one of the points that I would make about that is they are moving from an industry where there's high resource rent into one where essentially it's a manufactured energy where there's intense competition and very low margins. So, and it's a very crowded space already. So, you know, that's not a way to maintain rates of return on investments. It's actually a way to dilute rates of return on investments. You know, maybe if they corner the market in some of these technologies, they might be able to extract some value, but there's a huge difference between being able to get oil out of the ground at, you know, $5 a barrel and sell it for 50, and, you know, buying some solar panels and selling electricity at you know, at cost in the wholesale electricity market. You know, the margins are completely different there, and the risk is very different, much lower risk if you're selling renewable energy than if you're extracting oil from, you know, big long-term investments in exploiting new oil fields. So it's a completely different business, and it's not at all clear that oil and gas companies are well positioned to deal with it, and it's certainly the case that the rates of return on the investment will be lower, because that's already true. So you if you want straight value destruction over time, this transition from resource rent-intensive sectors to manufactured energy will clearly reduce rates of return in the energy sector. That does, doesn't mean it might not be worth doing at the whole economy level. The question is whether it's worth the existing oil and gas companies doing it rather than returning all the money to their shareholders and letting their shareholders invest in renewable energy companies, which is the alternative. Remember what you're doing with existing oil and gas companies investing in renewable energy is you're combining moving capital between oil and gas and renewables and doing it within the same company, which of course is not necessary. You don't have to combine those two things. Thank you for that question. Yeah, somebody's asked about timing. And timing, of course, is everything. So I've discussed this in terms of, yep, it's definitely the case that we're going to be on track to do the government's 2050 net zero target in the UK. Okay, that's a big assumption. An even bigger assumption is what the UK government might be doing is going to be replicated across the world. That's not at all clear. The cowboy economy, if you like, could continue in many parts of the world. Even though in Europe, we might be more serious about the net zero economy. And clearly, if you're an investor, you're making bets about how serious climate policy is, both in particular countries and globally. And the jury is very much out as to whether the world will be able to coordinate on a serious climate policy. And the most likely option still remains, some sort of split between, countries that will plow ahead with deep decarbonisation and other countries that will remain fairly laggard about it. And absent world government, that seems a very likely outcome. But that doesn't reduce the importance of the genuine political pressure in Europe to have net zero targets. If we decide that, our policy is net zero, then of course our companies and the capital that we're investing and the nature of our economies in Europe has to change, regardless of what might be happening elsewhere. And of course, it's a legitimate political choice that we can make in certain parts of the world to, forge ahead with decarbonisation, no matter what we think the rest of the world is doing. And to the extent that we demonstrate that it can be done, improving your local environment at relatively low cost, maybe that's going to be a good demonstration effect for other countries. And I'm not without hope that other economically significant countries will follow the European example. Very hopeful about what might happen to China. One remains optimistic about the US in the long term. But clearly there are lots of other countries in the world who might continue with the fossil fuel based cowboy economy. Yeah, are Extinction Rebellion correct in saying that saving the climate requires the end of capitalism? Well, yeah, it depends what you mean by capitalism. Okay, I would always, capitalism, I would characterize it as being about, the honest pursuit of profit, and if anything, we need more sensible pursuit of profit in order to keep the cost down, to get the technological innovation that's required. But what we might need is more coordination by government. net zero is a serious government policy objective which requires appropriate government intervention. Does that mean the government should own more of the economy? Absolutely not, necessarily. But it does mean you need a tight framework of regulation, carbon pricing, appropriate promotion of low carbon technologies that are at an early stage of development. So, in a way, do you think the green revolution that we've had is just about government intervention, or has it been about private companies responding to government incentives? Clearly, it's been about both. And we have had some very positive surprises. Both wind and solar costs have come down much more rapidly than many of us thought was possible a few years ago. There's been rapid advances in battery technologies. So, there's a lot of cause for optimism that the technology has actually developed quite well as a result of the huge incentives that we put out there to develop it. So, it's surely a bit of both in terms of capitalism plus appropriate government regulation. Yeah, stock market values and dividends, serious implications for pension insurance companies. Yep. I mean, I think one of the things that's true if the growth of stock market values goes down is people will just need to save more of their income, won't they? One of the things that's, if you think about what people have been doing, people have been saving sort of, I don't know, 5 to 10% of their income and expecting to live in retirement for 20 years. Once growth rates fall, you're going to need to save more of your income while you're working in order to support your retirement. And also people are going to need to retire later or keep working at least partly longer. That's not entirely a bad thing. Many people, of course, welcome it. And it's not clear that it's entirely fair that large percentage of the population are sort of essentially living off future growth, while other people are paying for their consumption through continuing to work. So yes, it does have implications for savings rates, and savings rates have been, traditionally very low in growing Western economies. And yes, the end of the growth economy means those need to increase. And we've begun to see that. Those of us who are members of the USS pension fund know that work-hard contributions have been increasing as growth rates have slowed. Anyway, I think, thank you for all your questions. Just to say thank you for joining me today, and do feel free to email me if you've got any burning questions that you want me to answer. And thank you all for coming today.